My friend Sarah's husband fixes heating and cooling systems for a living. No side business, no crypto, no rich uncle. And a few weeks ago, sitting in a folding chair next to me at our kids' soccer practice, Sarah told me, almost casually, that they just crossed their first $100,000 saved and invested. $19,000 of debt, gone. 6 full months of expenses sitting quietly in the bank. A family vacation last summer, paid in actual cash, on a repair tech's income and hers from working part-time at the school. And when I asked her how, because you know I'm the friend who asks how, she didn't say a word about cutting lattes or picking stocks. She said, Marcus has this thing he does every time he gets paid. It takes him maybe 10 minutes. He's done it every single payday for 6 years. That's it. That's the whole secret. A 10-minute routine, run on repeat for 6 years. By the end of this video, you're going to have all 5 steps of that routine, in the same sequence Marcus runs them. And Sarah was very clear with me that the order is the entire trick. Because most of us already do some of these things, we just do them in the wrong sequence, and the sequence is what decides whether the money stays. But before I walk you through it, I want to be honest about why this conversation hit me as hard as it did. If you've ever felt that little lift when the paycheck lands, and then felt it quietly drain away before the next one came. If you've ever told yourself you'd save whatever was left over, and then watched whatever was left turn out to be nothing again. If you've ever downloaded the app, started the spreadsheet, watched the videos, and then frozen, because it all felt like too many moving pieces for a person who is already keeping tiny humans alive. Then you already know exactly why I made Sarah repeat the whole thing twice while our kids ran drills in front of us. Because that was me. Honestly, parts of it still are. I'm Alora, and this is the Finance Mom HQ, where we talk about the money stuff nobody ever actually sits moms down to explain. So this is Sarah's story, the way she told it to me. First over that soccer practice, then properly at her kitchen table, where she walked me through what Marcus actually does with a paycheck. I asked her permission to share it, and she laughed and said, please, somebody told Marcus once. That's the only reason we're here. Before the 5 steps, Sarah told me about the years before the routine. She calls them the 3 traps, because she says they were caught in all 3 at once. And I think you'll recognize at least one of them, because I recognized all 3. The first trap, payday money feels spendable. The moment it lands, your brain files the whole number under available. And available money doesn't sit still. It leaks. Not on anything big. That's the sneaky part. A takeout night because the week was brutal. A couple of cart checkouts. The subscriptions nobody remembers agreeing to. And a few days after payday, that lovely full feeling is gone. And Sarah says she genuinely could not have told you where it went. Not because she was careless, because none of the individual leaks were big enough to remember. The second trap, saving from the leftovers. This was their official plan for years, and Sarah says it out loud now like she's confessing something. We'll save what's left at the end of the month. And here's what she learned the hard way. The end of the month never has anything left. Expenses grow to swallow whatever room they're given. That's not a character flaw. It's just what happens when spending goes first and saving goes last. The whole fix, she said, is flipping the order. Nothing else about them changed. The order changed. And the third trap, too many pieces. At one point, Sarah had a budgeting app, a printed tracker on the fridge, and a color-coded spreadsheet Marcus built at 11 at night with great enthusiasm. And they abandoned every one of them within a month. Complicated systems die, she told me. Not because people are lazy, but because a system you have to think about is a system you'll eventually skip. The routine that finally worked is almost embarrassingly simple. On purpose. Simple is what survives contact with real life. And one more thing before the steps. Because Sarah said it to me directly, and I want to say it to you. She knows some of you are thinking, that's lovely for them, but there's nothing left in our budget to route anywhere. Her answer? They started this routine in the tightest year of their marriage, with an amount so small she was embarrassed to tell me. The routine doesn't care about the amount. It builds the rail. And once the rail exists, every raise, every tax refund, every little bit of slack that ever shows up already has somewhere to go. If they'd waited to feel ready, she said, they'd still be waiting. Okay, the 5 steps, in order. Step 1. Marcus reads the pay stub before he touches the money. Not glances at the deposit, reads the stub, line by line, against a note in his phone that lists exactly what every line is supposed to say: the pay rate, the taxes, every deduction, every benefit they chose. Sarah rolled her eyes at this for years. It felt like the world's most pointless ritual. Until his company switched payroll systems. Somewhere in that migration, the retirement contribution he'd set up quietly reset itself to nothing. No email, no warning. The paycheck actually got a little bigger, which is exactly why most people would never have noticed. A slightly bigger deposit feels like good news. Marcus caught it on the first stub because the stub didn't match the note. One short, polite email to HR. Sarah remembers it was 2 sentences. Something like, "I think my last stub has a discrepancy. Could someone take a look?" And it was fixed before the next payday. Contributions restored. And here's the part that stuck with me. He asked around at work afterward, and almost nobody else had noticed on their own stubs either. Payroll departments are just people at keyboards, and people at keyboards make mistakes. With your raise, with your benefits, with the deductions you signed up for. If nobody in your house is checking, nobody on earth is checking. Sarah's phrase for it: somebody has to be the accountant of this family. It costs 10 minutes. He decided it was him. And it's not just errors, Sarah pointed out. It's changes. When Marcus got his last raise, he sat down and did the math himself. Took the percentage they'd promised him, worked out what the new number should be, and checked it against the stub. Because a promised raise and a correctly entered raise are 2 different events, and only one of them pays you. When open enrollment comes around every year and they pick their insurance, he checks the first stub of the new year to confirm that what they chose is what they're actually paying for. None of this is paranoia. It's just the difference between assuming the system got it right and knowing it did. And Sarah admits the whole family used to find this habit mildly ridiculous, right up until the payroll migration, when the world's most boring 10 minutes recovered months of vanished retirement money. Nobody teases the accountant of the family anymore. Step 2. Every dollar is assigned before payday, not after. This is the step Sarah says actually changed their life, and it's the one that flips the leftover trap on its head. Before the money ever lands, Marcus already has it divided, on paper in advance, into 4 jobs. The needs: housing, utilities, groceries, gas, insurance, the things that keep the household standing. The future: saving and investing. And notice that it's near the front of the line now, not the back. The debt. While they had it, a dedicated slice went to attacking the balance, and once the debt died, that same slice slid over to the future pile without a single conversation. And the fun, a real, honest amount for enjoying their actual lives, dinners, the kids' treats, Sarah's weekends away, spent completely guilt-free because it was assigned, not stolen from something else. The percentages aren't sacred. Sarah was clear about that. Some seasons the needs ate more than half, and the other slices thinned out. The point isn't the exact split. The point is that no dollar arrives without a job waiting for it. Money with a job goes where it's told. Money without a job wanders off. That first trap, payday money feels spendable, dies right here, because by the time the deposit hits, the money already belongs to something. She gave me an example of what the split flexes looked like in real life, and I think it matters because this is where most plans quietly die. The first hard season. The year their second car gave out, the need slice swelled and the fun slice shrank to almost nothing for a few months, and the old Sarah would have called that the plan failing and quit. The new Sarah just called it that season's split. The routine didn't break because the routine was never a specific set of numbers. It was the habit of assigning the money on purpose, whatever the numbers had to be that month. And I want to sit on the fun slice for one more second because it surprised me. I assumed a family running a routine like this would treat fun as the enemy. It's the opposite. Sarah says the fun money is the reason the whole thing has survived 6 years, because a plan with no joy in it is just a diet, and every diet eventually meets a birthday cake. They never have to fall off the plan because living their life is part of the plan. Written in, funded, guilt-free. Step 3. 3 accounts so the plan runs itself. This is where Sarah started laughing while she explained, because she said it sounds so unimpressive, and it's secretly the whole machine. They opened 3 separate accounts, and every one has a single job. One account for the bills, the fixed stuff. The moment pay lands, the bills money moves there automatically, and in their heads, that account simply does not exist as spendable money. One account for the future. Savings and investing flow out of this one. And one account for the fun. Whatever's assigned for living lands there, and when it's empty, it's empty. No shame and no rescue transfers. Sarah says the 3 accounts ended a decade of arguments because the question, can we afford this, stopped being a debate about feelings and became a 30-second glance at the fun account. There's either money in it or there isn't. Nobody's the villain. The system says no so that neither of them has to. And underneath all of it sits the cushion, the emergency fund. Their first real goal was 3 to 6 months of the needs only. Not their whole income, just what it costs to keep the house standing in a bad month. Because without that cushion, every surprise becomes a crisis that lands on a credit card. And one dead water heater, Sarah's actual example, from their actual life in their actual January, can undo a year of progress in one afternoon. With the cushion, the water heater was an inconvenience. They paid it, refilled the cushion over the next few months, and the plan never even flinched. That money lives in a high-yield savings account, earning real interest, doing its one job, standing between her family and panic. If Sarah's story is doing for you what it did for me at that soccer practice, this is the moment to hit subscribe, because this channel exists so that moms like us get told this stuff plainly, the way nobody told me, the way somebody thankfully once told Marcus. And you'll want to be here for the last 2 steps, because step 4 is where the money actually starts working, and step 5 is the 10 minutes that holds the whole thing together. Step 4. The future money moves automatically and in a specific order. This is the step Sarah understood last and now defends the hardest. None of the future money waits for willpower. It moves by itself on payday before anyone has a chance to feel generous or tired or tempted. And it moves in a deliberate order. First, if your job matches retirement contributions, capture every cent of that match before doing anything else. When Marcus put in enough to get his full match, every dollar he contributed got shadowed by his employer's dollar, which is a doubling nothing on the open market will ever legally offer you. Sarah calls the match the raise you already earned but have to claim. And after the payroll scare in step 1, you'd better believe they verify its landing. Second, after the match, they fund a retirement account of their own, the kind where the money grows without tax dragging on it for decades. I've told you before on this channel how much of a difference tax-advantaged growth makes over 20 and 30 years. Marcus and Sarah treat that account like a bill that must be paid, every payday, no exceptions. Third, only after those 2 are fed does anything go into ordinary investing. Steady, boring, buy-the-whole-market investing, no stock picking, no timing, just the same quiet purchase every payday, regardless of what the news is screaming. I asked Sarah whether Marcus ever fiddles with it. Pauses when the market looks scary, doubles up when it looks exciting, and she actually laughed at me. Never. Not once in 6 years. The purchase goes through on payday like a utility bill. She says the automation isn't just about convenience. It's about protecting the plan from their own moods. There were seasons when the news was terrifying and every instinct said, stop, wait, hold on to the cash. And the transfer just went anyway, because no one asked their instincts for permission. And looking back, she says, the scary seasons the machine bought straight through turned out to be some of the best purchases they ever made. Neither of them is a genius, she told me. They just built a machine that doesn't panic and then let it outvote them. And Sarah added one thing here that I want to pass along exactly, because it reframed debt for me. While they were carrying their high-interest balance, its payoff came before the extra investing, because erasing interest that's bleeding you at 20-something% is a guaranteed win no investment can promise. She stopped thinking of the debt payments as losing ground. Killing that balance was wealth building. It just wore a different uniform. Step 5. One short money date a month. Everything so far runs on rails. This last step is the only part that needs actual humans, and it's 10 minutes. Once a month, after the kids are down, Sarah and Marcus sit at the kitchen table with coffee. She was adamant that it's coffee and not a screen glow misery meeting, and they answer 3 questions. Did everything actually run? Transfers out, contributions landed, Stub still matching the note. Verify, because step 1 taught them what silent failure costs. What's coming next month that isn't normal? The birthday, the school trip, the car registration. Name it now, set money aside now so it never gets the chance to ambush the cushion. And are we still on track? A 30-second glance at the balances against the goal. Not to judge the month, just to stay connected to the thing they're building. Sarah says the money date matters beyond the money. Every month they show up for it, they're telling themselves they're the kind of family that handles its business. And that identity, she says, compounds exactly like the account balances do. 6 years of 10-minute check-ins, and somewhere along the way, they stopped being people who hoped it would work out and became people who knew where they stood. So that's the routine. Let me lay it out one more time in order, because the order is the trick. Read the stub before you touch the money. Somebody has to be the accountant of your family. Assign every dollar its job before payday. Future near the front, fun included on purpose. Split the money into 3 accounts so the plan runs without debates. Move the future money automatically. Match first, then your own retirement account, then plain, steady investing with high-interest debt jumping the line while it exists. And once a month, 10 minutes, coffee, 3 questions. Notice what's not in there. No app with 17 categories. No perfect discipline. No big income. I promise you, nobody hands out fortunes with the heating and cooling van. Just a short routine, in the right order, repeated every payday until the repeating did the heavy lifting. And notice one more thing, because Sarah pointed it out, and it's the part I keep chewing on. Every step exists to remove a decision, not to add one. Reading the stub removes the assumption. Assigning the dollars removes the nightly, can we afford this, negotiations. The 3 accounts remove the mental math. The automation removes the willpower. Even the money date mostly exists to confirm that nothing needs deciding. 6 years ago, Sarah and Marcus were making dozens of small money decisions every week, exhausted and mostly losing. Now they make almost none. The routine decided everything once, in advance, and payday just executes it. That's the real difference I saw in my friend at that soccer practice. It wasn't the $100,000. It was a woman with no money decisions weighing on her at all, watching her kid play, completely present. That's what the routine actually bought them. I'll tell you what happened in my house after that soccer practice, because you know by now I don't collect stories without acting on them. That same night, David and I pulled up his pay stub and actually read it, line by line, for what I am ashamed to admit was the first time in years. Everything checked out, except one benefit deduction neither of us could explain, which turned out to be a leftover from an old election he'd meant to cancel. One email, done, and that little slice now rides along with our savings transfer instead. And we put a money date on the calendar. Ethan thinks money date means we're going somewhere with snacks. Honestly, coffee counts as snacks. He's not entirely wrong. So here's my question for you, and I genuinely want to know. Out of the 5 steps, which one could you set up before your next payday? Just one. The stub, the jobs, the accounts, the automation, or the 10 minutes? Drop it in the comments. And if you know somebody who works hard for every dollar and deserves a system that finally keeps some of it, send them this video. You might be their Sarah. I'm Alora. This is the Finance Mom HQ. Raising kids and retirement funds. Go take care of both, and I'll see you in the next one.